Every now and then I have those direct Zoom consultations with various members of this community. And while it's interesting to look at portfolios, while it's interesting to look at different altcoins and investments, it's even more interesting how we tend to see repeating questions all the time. Questions that pop up in almost every single of those calls. And one of those questions is, how much should I actually invest? You know now my portfolio, you know now what I invest in A and in B, you know my income, you know my age, you know my savings rate. How much should I actually invest? How much should I risk? And the interesting thing is that this is not as easy to answer as it first seems. So there's the one camp that says you should only invest what you are able to lose, what you can afford to lose. So don't put all your eggs into this one investment and then hope for it to go up, because if it doesn't, if it suddenly crashes 60, 70, 80%, you might have to restart all over again. So that's camp A. But then there's also camp B, and camp B says you should always invest everything all the time, because over the long term most assets go up, right? House prices go up over time, stocks go up over time, Bitcoin goes up over time. So you might as well invest everything, because the value of the US dollar is going down over time. We see a monetary base expansion of roughly 6.8% per annum. So if you have your money just in plain old cash somewhere under the mattress, you are losing 6.8% of purchasing power every single year. And so this argument also makes sense, right? Both of those arguments to a degree make sense. So who's right here? The answer is actually not in the middle. The answer is both are right, but the way to make this all happen in a portfolio is through diversification. So we want to be invested with everything at all times, but we want to be invested in different ways. So I want to reduce the overall risk of our portfolio. We want to, by all means, avoid that we crash by 50 or 60% in our net worth. But we don't want to achieve this just by being in cash. We want to achieve this by buying risk, by buying assets that don't have much to do with one another. So the problem is when we have, say, all of our investments in one asset class. Let's say we buy a lot of property, we have various houses. That means if we get into a property crisis, all of our net worth is going down. And then recovering from such a draw is very, very hard. Let's say your net worth, because you put all your money in this one asset class, be it property or be it, say, stocks, and then suddenly things crash by 50%. From that lower level, we need a 2x just to be back again at our normal level. We started off with $100, we go down by 50%, now we are at $50, and those $50, they need to double in order to go back to $100. So we want to reduce our volatility, and we do this by buying different things. And so we want to be 100% invested. That does not mean that we have to be always in crypto and always in risk on, so in other stocks and potentially even in very risky property. But it does mean that for whatever dollar we own, we want to at least get some kind of return. So it's still fine to be very much risk off. Let's say you are in your 60s, you are potentially even in retirement, your regular cash flow isn't that high anymore, if you have any at all. Your cash flow, at least relative to your net worth, is relatively small. In that case, you have to protect your capital even further. But it's okay to be in cash as long as the cash returns something. It probably won't return the 6.8% debasement, but if you can get at least, say, 4 or 5%, then the majority of the debasement at least is counteracted. And so we simply take on more and more risk, the more return we want, but we want to make this in a smart way, and we want to buy assets that are not that much correlated to one another. So another way to think about this is that we want to generate the returns while at the same time reducing our risk of ruin. So the risk of ruin basically means we go close to zero, we put everything in one asset that we think has the highest chance of going up, where maybe our expected value is very high, that it will make a lot of returns. But even if the expected value is high, if the risk of ruin is relatively high as well, it's not really worth it. So imagine, let's take gambling as an example. Let's say you have a roulette table, and from that roulette table, there's a 50% red, there's 50% black, and you get offered a very good opportunity. You get the opportunity that in case it hits black, you say 10x, your capital, and if it's red, you lose the money. So you would always play that game, right? The expected value is positive. You make it 10x in 50% of the cases. But there's also a risk of ruin of 50%. So this might not necessarily be a great gamble if you have to put everything, your entire net worth in it, and if it takes a long time to recoup that. Right? Let's say you are 60 years old, you saved your entire life, and you get offered that particular gamble for all of your savings that you've ever made. And you're not allowed to sell any shares to anybody to help you split the risk. It's really just you and the table with your few $1 million, and you can 10x that or you can lose it all. In that particular instance, even though in isolation this might be a good bet, it's not the best bet for you, right? You probably want to have retirement without having to potentially work again or even live very poorly. So that's what we have to think about. We have to think about our risk of ruin. The risk of ruin gets reduced if we diversify. Our risk of ruin also gets reduced when we have some assets that have very little volatility, if any volatility at all. And so that's how we have to think about this. How high is our net worth relative to our regular income? Or more specifically, relative to our regular savings. So how long would it take in order to potentially get back a loss? So if your net worth, say, is only 3 months of savings, right? Let's say you save a third of your income, you've got 1 month of income saved up, that's all your net worth. If you're in that position, you can afford a lot of risk. So if you found that bet, right? You found the potential 10x return in 50% of the cases, and the other 50% it's zero. Of course, it's never that easy to measure it, but let's say you found that kind of bet. It's okay to bet everything on that. Diversification is not for you because you can very easily get that money back. You just save for another 3 months and you're back to square one. However, if your net worth is relatively high, you should not gamble with that. Now, where's the cut-off point here, right? When should we get more conservative about risk management? I think the cutoff is at the 2-year mark. So everything before 2 years is relatively easy to recoup again. So 2 years in terms of saving. Right, let's say you make 100K per year, you save 50K. Once you are at 2 years of savings, so that would be maybe 1 year of income if you're saving very aggressively. Once you're below that, it's still fine to take huge bets. It's still fine to potentially even take the chances of getting to a risk of ruin, the chance of getting to the total ruin. That's potentially not really an issue because you can get the money back. Also, the safety, of course, of your income is important. Also, potentially the growth rate of your income is important. Usually when you're early in your career, when you've got a lot of time to get the capital back, when your income tends to grow, when you also have a relatively safe employment or a safe source of income, you can take all of that risk. The 2-year mark is important because this is where we have to really switch from active speculation to more controlled risk taking, to more controlled investing. That's where the diversification effect comes in. Because let's say again let's even get a more optimistic example. Let's say you have 6 months of income saved up. Your net worth is 6 months. If you now are relatively successful at trading, right? You've learned for several years, maybe not with trading actively, but you've learned for a while, you're at 6 months of net worth, you are able to outperform your market by say 10% per annum. So you get the 6.8% monetary debasement, you get another 10% because you can time the market, you can find the right assets, etc. You have a bit less than 1% edge per month, but you are say at 10% plus the 6.8%. If you are at 6 months of net worth, how much additional money do you really make per year? Not that much, right? It's a bit over 2 to 3 weeks of income. So you're working the entire year trying to beat the market, and in the end, all that you have to show for it is an extra 3 months of income. At that point in time, right, if you don't just trade for the learning activity, but you're actually trading to make more money, it's probably better at the time to put the vast majority of your effort, of your mental effort, into just adding another side hustle or into just maybe changing jobs and increasing income that way, right? Maybe when you switch jobs, you get another 10, 15%, or maybe when you're at a side hustle, you get another 20, 30%. So that way, you can build your wealth much quicker at that point. You don't have enough capital to leverage. You do have enough capital to take some wild bets and to potentially make this pay off massively, right? It is potentially okay to hit for to really swing the bet, hope for the home run at that point, right? If you even go from 6 months to 1 month down, no real issue. But you have to then switch this once you are at the 2-year mark, because at the 2-year mark, it actually does matter. So when you're at 2 years, that's equivalent to 24 months. Now you are at the 10 to 20% performance per year, right? So let's say 16.8%. Suddenly this makes sense, right? 20% on 24 months, that's almost 5 months of extra income. So let's say with the trading, once you're at 2 years of net worth, 2 years income net worth, that alpha is suddenly 4 months extra income. That's a third of your regular income. You can actually now afford to have 25 to 33% of your time just focused on trading. So that would be the rational thing to do, right? Once you're at the 2-year mark, it does make sense to do the active trading because the returns now suddenly are relatively high compared to just your regular income. Suddenly things start to make sense. It also makes sense to make the switch at that point because once you are at the 2-year mark, inflation does eat up your wealth quite a bit. So let's say before you were hyper conservative, you didn't even take any returns in terms of fixed deposits. You really just had the cash under your mattress. You had 24 months and you have the 6.8% debasement. Suddenly you have more than a month, maybe 1.5 months roughly, that you're losing every year due to inflation. So in other words, 1.5 months every year you're just working for free for the monetary debasement. This is time that you could in theory take off. Right? This is time where you could have vacation and an extra 1.5 months per year. So this is where it really flips. So the 2-year mark is really a game changer. When you are below that, when you're just at a few months, you can go really, really risk on. If you go from say 6 months to 2 years, it might make sense to not bet the entire capital all the time. It might make sense to be a bit more conservative. But after the 2-year mark, it really makes sense to put much more mental effort into investing. Figuring out how we can achieve returns that are high enough to beat monetary debasement, figure a market where you're safe enough in to potentially beat that market. So learn everything about crypto or learn everything about the property market, learn something where you can actually be among the top 10% of market participants to actually be able to beat the market. So have something that you can beat, have the other markets where you can diversify, and then just grow, let your capital grow with you. That then over time, it's not just say a quarter or a third of your income, relatively speaking, but then over the next few years, you can then grow this, that the income through investing or through appreciation of your assets becomes even larger than your regular income. And usually, that's what's like the rule of thumb is, usually once you are at the 20-year mark, you can really afford to completely retire. Right, so that's the idea of the 5% withdrawal rate. Once you can beat the market a little bit, once you withdraw 5% of your capital, then you can just live off your net worth. So that's how to think about the risk-taking curve, right? You want to take on a lot of risk when you are poor. You want to take on gradually less risk as much richer you get. Once you are at the 2-year mark, you want to really start focusing on this as the next step forward. You probably don't necessarily want to focus just anymore on getting this new pay rise at your job. You probably don't just want to focus on your active income. You want to start leveraging your capital as well. And then it's about just growing this over and over again, double this every few years until you're at the 20-year mark. And the 20-year mark, it's all about retirement. So this is, I think, most people don't really get when you think about how much should I invest. The answer really is you should invest pretty much everything, and in every singular asset class, it's important to invest that much that your overall net worth won't drop too much. So you should always try to avoid to drop more than 50% in your net worth in the worst case, right? If you are, say, at 10 years and then you drop by 50%, first of all, doubling this again will be a pain, but also at that point, right, when you are down from 10 to 5 years, getting back to 10 years It's pretty much impossible to be achieved just by saving your active income, right? If you save your active income, you might take many, many years to get 5 years of income back again. So really at that point, when you're in multiple years of income, figuring out a way to manage risk is super, super important. And this is what many people do wrong. Most people take too much risk when they're very rich, or they maybe take even too little risk when they don't yet have the net worth, and they just hope that they will become rich by dollar cost averaging in the S&P 500 and saving just 10-20% of their income. That's also not going to cut it. Right? It's all about saving as much as possible in the early years and not necessarily focus that much on the returns. But then there is a cutoff period where the focus really should shift from just active income generation. That was the focus all up until that point, to then really figure out a way to lever all of that capital. Let me see if there's anything else. Yeah, there's one more question I sometimes get asked, and that is, when can I actually consider investing or trading a full-time occupation? And again, you obviously need some capital to do that. If you just want to be completely passive, I've already said this, it's 20 years, right? The 5% withdrawal rate. You just have some money in Bitcoin, some money in property, some money in crypto, some money in precious metals, some money potentially in government bonds, right? You have all of that. It's just diversified. You don't actively manage it. You just don't want to think about money at all anymore. Then it's the 20-year mark. If you want to live off trading, then you just have to think about, what is really my alpha, right? So how much more do I generate by trading actively? And if the answer is, say, 10% per annum, then the answer is you need 10 years, right? You need 10 years of income in order to get one additional year of income just from trading. Most people, though, if you get really deep into this, right, if you really do full-time research and you know your risk management, you can already start doing this full-time once you're at the 5 to 6 year mark. But then again, right, there is volatility. So once you move from 6 years down to 4 years, potentially even 3 years, you might have to restart whatever active income source you had, whatever active occupation you had again. So then it's a bad idea when you go from 6 to 4 years and you trade to try to get the money back, right? Then you have to actually stop and just save again until you're back at 6 years. At least you have to stop doing this as your sole occupation. So those are, I think, relatively realistic thresholds to think about this. Hope you got some value out of this video. If you did, then feel free to give this a like. And feel free to also subscribe. I publish videos here regularly. And feel free to also check out the premium membership. This is where I share my own trades. So for the monthly subscription, you get every single one of my trades. You can simply just copy trade that. Or if you sign up for the annual membership, you can even deposit your money into a capital pool, and then I will trade for you. I've also shared my personal performance in prior videos here as well. See you later. Cheers.